Good morning, good morning. I trust and I hope that you are well. Oh, sorry. Um, it's actually in the evening right now. My bad. Good evening, good evening. I apologize. So, uh, I can see that it's only one person in the chat for now. So I'm just gonna wait like 3 minutes so that we can all start at once. So I'm just gonna officially start at 3 past. If there's no one by 3 past, I'm just gonna continue and also just continue recording. Continue recording. Then we can start together. The others, if they don't make it today, perhaps they'll just have to rely on the recording. So start at 3 past. Right, once again, good evening, everybody. I trust and I hope that you guys are well. Um, Now, I wonder where your fellow classmates are because time for class has already started. But anyway, it's all right. Um, so today we're gonna continue where we left off. Today we're gonna continue where we left off, and we're gonna do lecture number 2. It's basically unit 2, a continuation. We should be done today, and by the end of this lecture, we should have also covered a bit of financial statements. Right, so guys, at any point, please do feel free to ask questions. Do not do not be shy. If you're shy, at least type it down. Do not die in silence, right? Do not die in silence. When I was attending one of the classes that say James was teaching, I saw someone saying Sobonane Matunen. Okay, here there will be no graves in my class, okay? We are all gonna go together where we are going. All right. So now, um, we did recording transactions for purchases, and then we did for credit sales and cash credit purchases and cash purchases as well, right? Yeah, and also credit sales as well, right? And we spoke about we didn't actually speak about credit sales, did we? No, we didn't speak about credit purchases. Yes, we spoke about trade receivables, which is credit sales. Right. So today we're going to be continuing and we're going to do recording transactions for purchases, which and also depreciation and sales. So we're talking about purchases, depreciation, and sale of assets, right? So the purchase of assets, the depreciation thereof, right? And also the sale thereof. So a business will acquire long-term assets that will assist them in achieving their strategic objectives. These assets can be manufacturing equipment, vehicles, or property that will hopefully help to generate future income and grow the value of the business. Now, these non-current assets lose their value over time through use and or obsolescence, right? And therefore, it needs to be depreciated and or adjusted to reflect their correct value in the books of the business. Now, regarding non-current assets, the only asset which doesn't depreciate that we're going to speak about is land, right? I do not want people that depreciate land. We do not do that here. Because I once saw somebody, land and buildings do not depreciate, right? Because I once saw a meme. It was actually a, BD, a building which was falling apart, and it was saying me after depreciating my buildings in the exam. So unless maybe there is an earthquake or something, a building does not depreciate, right? They actually appreciate as time goes on, which means they gain value, right? So the rate of depreciation, which is also referred to as useful life, will differ depending on the depreciated faster than a building, for example, to sell the asset. Right. That is where the sale of assets is going to come in, and also profit and loss is going to be incorporated. Right. So the proceeds from the sale needs to be compared to the carrying value of the asset to calculate if a profit or a loss was incurred in the sale, just as I have said. Now, to put this in context, let us do a quick example. Right. You know, I have a thing about recording. Let me see. On purchase for 250,000 Rand cash years, right? The company depreciates vehicles on a straight line basis each year. So on 1 January 2019, the vehicle was sold for 180,000 cash. Now, firstly, we want to ask ourselves, how long was the car in use? We are told here that the car has a useful life of 5 years, right? Which means that the depreciation rate is five 5 years, right? Which we'll calculate just now, right? So it means that by the end of 5 years, it will basically have a price of zero. That's what this is telling us. And I will show you guys the formula, right? So now on the 1st of January 2017, a vehicle was purchased for 250,000 cash, right? On the 1st of January 2017. And then it was then sold now on the 1st of January 2019. Right, so let me just highlight these dates. Let me just highlight these dates. As you can see, it shows us that the vehicle has been in use for a total of 2 years, right? So 2 full years, right? So we want to calculate what we call the accumulated depreciation of this vehicle over the 2 years. That is what we're going to use. But before we rush there, right, let's take it step by step, right? So now what is required from us from this statement? Remember, I said we take it step by step. So when a vehicle is purchased, right, for 250, that's step one. Right? When a vehicle is purchased for 250,000, how do we record this? Right? So we're going to have a vehicles account, and then we're going to have a bank account, right? Because this money is coming from our bank account going into the vehicles account, right? Because the vehicle is an asset. So it's part of the asset account. So the vehicle account is gonna be debited with 250,000 because assets are increasing, right? We can all agree on that. So on the 1st of January 2017, the bank debits 250,000 into the assets vehicle account, right? Now, remember, for every debit, there must be a credit, right? That's our double entry principle. For every debit, there must be a credit. I hope we did not forget that. I hope we did not forget in our previous lecture. Right. So now the bank debits into the vehicle account, which means that the bank is the one that is credited. Right. So money is coming from our bank into the assets account, which is the vehicle account. Right. So now, any questions on how we recorded this transaction? Any questions on how we recorded this transaction? Hello, guys. Are we together? All right. So if you guys are good, then we are great. Right. So the asset account is increasing. Remember, when we increase in assets, we debit, right? When we increase assets, we debit. Right. So now, step two. Right, so we've recorded the transaction of the purchase of the vehicle. Right, so now it is estimated that the vehicle has a useful life of 5 years. This is where our depreciation comes in, right? The company depreciates vehicles on a straight line basis each year. So we are going to calculate the depreciation each year because we said this vehicle was in use for 2 years, right? The depreciation for 2 years is what we need. The accumulated depreciation for 2 years is what we need. Right. So the depreciation account is debited and the accumulated depreciation account is then credited. This account is always credited because it is a contra asset account, which means that it's decreasing our assets values, right? It's decreasing the value of our assets. That's why it's credited. Right. So depreciation is an expense, so it will be debited. Right. So now let's calculate. This is the formula we use. Depreciation expense is equal to the cost of the asset minus scrap value divided by useful life. So if we're not given the scrap value, we just say zero, right? The scrap value, which means that it will be zero. Well, in certain instances, which I haven't really come across in our module, even in past papers, um, what happens is that um, they will not really mention the scrap value most of the times. They will not mention it, right? But it's always good to know the formula. You never know when it can pop up. So the scrap value is basically the value at which now the asset should just be disposed. Right. Where the value, so when you're not given, we assume that it's zero, right? When depreciation can no longer be applied to this asset, right? So we are saying that when the value of the asset is now zero, right? So the vehicle is losing 50,000 per annum as calculated here, right? So the cost of this asset is 250,000 minus zero divided by 5 years, which is the useful life which we are given here, right? 5 years. Let me just highlight that as we are going step by step so that you understand what is important, right? Useful life is 5 years, right? So it's our answer for depreciation each year is 50,000 per annum. Now, we are not given the scrap value, right? Like I just emphasized. So it's gonna be zero. But if you are given, you subtract with the scrap value. They will specifically tell you this is the scrap value of the asset. Right. So now, accumulated depreciation. What is accumulated depreciation? For those that are wondering, let me just explain it in terminology that we can understand. Right. So the accumulated depreciation is used to track the total amount of depreciation expense that has been recorded for an asset since it was acquired, right? It is a contra asset account, meaning it offsets the value of related assets. And with this, also just a little reminder that something I need to tell you is that accumulated depreciation, it doesn't get updated every year, but depreciation will get updated every year. So accumulated depreciation will be the same every year, basically, but accumulated depreciation increases. So we are using the same depreciation every year. But as you see, as the years are progressing, accumulated depreciation is actually increasing. Right. And you see where that comes in at hand when it now comes to the asset, to the disposal of the asset. Right. So now that we understand what accumulated depreciation is, how are we going to record this transaction? So we said 50,000 per annum, right? So that means that we need to calculate for the 2 years that it was in use, right? So what we're going to do is that depreciation, in our depreciation account, we are going to debit 50,000, right? Because remember, you debit depreciation because it is an expense, right? Accumulated depreciation for vehicles, 50,000, 2017, December 31, at the end of the year, right? Then in 2018, we do the same. But remember, before we go to 2018, for every debit, there must be a credit. So which means that when we credited here in 2017, in 2017, in the accumulated depreciation account, we are also crediting 50,000, right? So now, December 2018, we credit again, we debit again into the depreciation account 50,000. And then we credit on the accumulated depreciation 50,000. Right. So this side, we now have 100,000. Right. This side, every year, it will be 50,000. But this side, we now have 100,000. Right. So now that we've calculated this part, on the 1st of January 2017, right, we've already done this part. We've done the second part, right, which is the depreciation part. And then now we are told on the 1st of January 2019, the vehicle was sold for 180,000 in cash. Right. It was sold for 180,000 in cash. So remember, when a sale of an asset is made, we're either selling it at a loss or we are selling it at a profit. Right. So what I would normally advise for us that are new to accounting is that we maybe calculate the profit or loss before we even go to the next step, right? Just like how I did here. So 250,000 minus 100,000, right, will give us the value of the asset at the time at which it's sold, right? So basically, we are subtracting accumulated depreciation from the original price of the asset, right? So we are subtracting this so that we can be able to calculate the value of the vehicle at the time at which it is sold, right? So now, basically, in other words, it's selling price minus the cost price. Cost price at the particular time which it was sold. Right. So we see here that our cost price is 150,000. Right. Our cost price is 150,000 because 250,000 minus 100,000, which is our accumulated depreciation, will give us 150,000. Now, what is our profit and loss? Right. So we are told that, okay, let me not go far. We are told that this vehicle is sold for 180,000 in cash, right? It's sold for 180,000 in cash. So for profit or loss, we subtract selling price from cost price, right? The price at which we are selling it and the actual cost price, right? The value that it's valued at in our business. Right. So we are seeing that there's a profit of 30,000 being made because we sold it at 180,000, but yet it was actually valued at 150,000. Right. So now we are going to talk about what we call asset disposal. When we talk about profit or loss, we're going to talk about asset disposal because there's a certain way which we need to handle this particular account, right? There's a certain way which we need to handle this particular account. And if we do not do it that way, we will find ourselves confused, right? Remember, what I was just doing is showing you the math behind what we're going to do now. right? We have a profit of 30,000, right? So now, in this step, we have to calculate and record the profit or loss relating to the sale of the vehicle, like what we just did, right? So now, we also need to remove the vehicle and the accumulated depreciation from the general ledger. So if this vehicle, we are selling it, right? We are selling it. We need to remove it from the accumulated, we need to remove it from our accounts, basically. We need to remove it from our general ledger, which means that, remember, this vehicle is no longer in our business. So we are removing it from our account, right? So in our general ledger, there needs to be a way to remove it. How do we do that? Right, so we are going to speak about that just now. A control account, which is called proceeds from sale of vehicle, is opened where all transactions, including the profits, is recorded. Right, so the account should be balanced and have the same total for both the debit and credit side. So which means that this asset disposal account should be equal on both sides, right? Regardless of whether we made a loss or a profit, it should be equal on both sides, on both the credit and the debit, right? It should basically balance. Now, excuse me, before we go there, something that I just want to highlight. How do we remove an account? Right. So, just a hint. To remove an account, we must do the reverse of what we did so that the account can be debited, can have the same amount on the debit and the credit side. Now, I'm going to show you how we're going to use the asset disposal account to do this. Right. So, we have calculated our profit and loss. We already know that, right? But we don't even need to do that when we are doing asset disposal. Here's why. So, firstly, right, this vehicle that we are selling, right, we are selling it for 180,000, right? So, which means that our vehicle account, right? So, at first, our vehicle account is debited with 250,000, right? So, it's debited when we bought the vehicle, right? So, now we are selling this account. But when we are disposing it, when we are recording, right, into the asset disposal account, we are we are debiting it into the disposal account. So as you can see, this now cancels off, right? This now cancels off because our vehicle account has 250,000 on the credit side and then 250,000 on the on the credit and the debit side. So that means that it is cancelled off. So now that it's in our asset disposal account, what's our next step, right? So what happened next? We received 180,000 in cash, right? For the purchase of this vehicle. We are receiving 180,000. Okay, fair enough, right? So now, how do we record that? Our bank is debited. Remember, this money is coming into the bank. So the 150,000, 180,000 is debited into the bank account. So we're going to debit our bank account. And where is it being debited from? The asset disposal. Basically, this money is coming from the disposal of the vehicle, right? Or of the asset. So on our asset disposal account, we credit 180,000. This is all based on the double entry principle. If we forget that principle, then there is nothing we are doing. Right. So now let's talk about accumulated depreciation. Right. So why are we crediting accumulated depreciation and debiting it? Remember, like what I said, we must remove this because we cannot have accumulated depreciation for an asset which is not there, right? So it needs to be off of our books, right? So we are now gonna do the reverse because remember, initially we credited our accumulated depreciation account with 100,000, right? So now to do the opposite, we are gonna need to basically just credit the asset disposal account, right? We are crediting the asset disposal account and then we are going to debit into the accumulated depreciation account. And that will now cancel the accumulated depreciation account because we have this 100,000 here, and then we have the other 100,000 on top right here. So we have 100,000 on debit, 100,000 on credit, which means that that account is now scratched out of our books. Right, so we basically debit into the asset accumulated depreciation account from the disposal of the asset. Right. So now, how then do we come about the profit and the loss? Right. So we say that the profit of the vehicle is the profit from the sale of the vehicle is 30,000. Right. It's 30,000. So what we're gonna do here now is that we can do this one of two ways. We can calculate profit, like I said, and then um or let's rather do it this way. This way will be much better. Right. So, as we can see, our left and our right must balance, right? Our left and our right must balance. So, on our right, we have 250,000, which on our left, I mean, which has been debited, right? From the disposal of the vehicle, right? And then, so basically that was the vehicle account coming into the asset disposal, right? And then our bank, we have credited 180,000, right? Because 180,000 is going into our bank, right? And then we have also credited 100,000 of accumulated depreciation, right? Because we want to cancel off this account, and we cannot have accumulated depreciation for an account which is not there. Now, as we can see, if we add what's on the right side, we'll get 280,000. 180,000 plus 100,000 gives us 280,000. But before we have this profit and loss, right, before we have this profit and loss, our account is at 250,000 on the debit side. So which means that it's not balancing, right? It's not balancing. So by how much is it not balancing? It's not balancing by 30,000. So, because if we say 280,000 minus 250,000, it gives us 30,000, right? So that means that our account, we either made a profit or a loss of 30,000, right? So we record this 30,000 into the debit side of the asset disposal, right? Because it's the one that is not balancing. And I'll explain to you shortly now how we determine why it's profit in this instant. Right. So now, here we have 30,000. For every debit, there must be now a credit. So which means that there must be a profit loss account which we are crediting from. So here's our profit and loss account, which is credited with 30,000. And now everything else is balancing. Right. So why are we crediting profits on sale? That is because profits are income, and income increases owner's equity, hence it is created. Remember in the first first lecture when I spoke about this. Is it the first or the second? I'm not sure. No, yeah, it is the first one. I think it's unit 2 or unit 1 at the beginning of this unit. That equity and liabilities will be credited, assets will be debited, right? So if our owner's equity is increasing, we need to credit, right? Hence why we are debiting into the asset disposal account and crediting from the profit and loss account, right? Any questions on this disposal of the asset? Any question on asset disposal? I'm gonna give it a few minutes to digest. Maybe some people are still hearing gibberish. Do I have any questions? Come on, people. We are together, right? Are we together? Just say Donny. Don't be shy. Remember, I said as Bonani Matuneni here. Everyone is gonna We are with the living today.
I don't.
Um, yes.
Can you please go up a little?
Mm-hmm.
Yes, go up, up. There was a formula which you showed up.
Oh, this one here.
Yes.
Mm-hmm.
You lost me when you were talking about scrap value.
All
Uh,
right.
yeah, can you please clarify it
As
again?
to as to why it's zero in this instant.
What is a scrap value at first,
All right.
and why is it
That
zero?
so now that's a very good question. Basically, scrap value is the value at which the asset is the value of the asset after its at the end of its useful life. Is the value of the asset at the end of its useful life. So in this case, we're assuming that the scrap value is zero because at the end of the useful life of the vehicle, it should be worth 0 rand. So it
So
it is not always
what is the useful life of this vehicle?
okay. So I think we're having two questions now. Useful
Yeah.
life and scrap value, right?
Uh,
So
The second
remember,
question is
useful
a
life
follow-up
is
question.
so okay, let me just give a background and overview of this, how it works in accounting. A business will have a certain value that they use to depreciate their assets, right? Each and every business, right? It differs, right? So useful life is the period in which this asset will be considered as a valuable asset of the business, right? And then scrap value is basically when the asset has become fully depreciated, which means now it can no longer be of any use to the business, fully depreciated. Making sense?
Yes, yes, Don.
So, scrap value is basically the worth of an asset, right? At the end of this useful life. So, why I'm saying that it will not always be zero, it may not always be zero, although in most of the examples we are going to do, it's going to be zero, right? Is that a business could consider their asset fully depreciated, maybe at the price of 25,000 in this, and they will tell you most of the time, they will tell you that the scrap value of this asset is 25,000. So what do you do? Instead of putting zero, you put 25,000 on the 25,000 on the scrap value side when you're now substituting into the formula. Did I answer your question or you are still lost?
Yes, Don, but what do I want to say? I just want to be sure that I'm hearing you about this scrap value. What?
Okay,
You are
okay, that's fine.
saying
So let's
it's when an asset depreciated fully.
yes. So at the end of its useful life, which means that it is fully depreciated. So what is
That
depreciation?
that means it is the value of the asset is zero.
Yes, yes.
Like for instance, here the example you gave us, the depreciation was 100,000.
That's the accumulated depreciation.
Okay, so
So basically, that's the depreciation over
the
2 years.
depreciation. Depreciation was
50,000 per year. So which means
50,000.
that every year the vehicle is
It
losing
depreciated with
50,000 in value.
50,000.
Yes.
Then on the
So
third
after
year,
2 years, it has lost 100,000, right?
after 3 years, it will be 150. And then the vehicle will cost 100,000.
Okay.
Okay,
No.
okay. I got you. I got you, Tony.
Oh, you got it. Okay. That's
Yes.
great. That's great. Anybody else with a question on this whilst we are still at it so that I don't lose anybody? Mavuso, Mavuso. Mavuso, it seems like Mavuso just left. I was about to answer your question. Mavuso is saying they are lost, but I don't know where we lost Mavuso. I don't know, maybe they could tell us when they come back. Let me just write in the chat. Okay. Right. Besides that, is there anybody else with a question? All right. So basically, let me just, maybe I may have assumed that we know some of these terms. Depreciation, right? Depreciation rate is the rate at which if an asset is losing value. Right. Right. Great stuff, Member Fuller. Is the rate at which an asset is losing value. Right. And then scrap value is basically when the asset is now fully depreciated, which means that we can no longer apply any more depreciation to it. Right. That is the scrap value. And then useful life. Useful life is basically how long an asset is going to be valuable to the business until it is fully depreciated, until it has reached its scrap value, in other words. Right. So how do we calculate for depreciation expense? Because depreciation is applied annually per year, as you can see. You will see instances where maybe it will talk about monthly, but that will be very specific. But for now, let's look at it in the period of a year. Right. So that is basically depreciation. It seems like everybody's all right and we are all on the same page, except for Mavuso who left. I hope they can write their question when they come back. But guys, anything on asset disposal? Are we together? Did I rush through anything? Did I mumble maybe something that you didn't hear? We are here to help each other, to lead each other to the lights, not to the graveyard. Okay, your silence means to me that we should proceed. So great stuff. We are going to proceed into more interesting things. I'm excited, aren't you? This is one of my favorite parts now of this unit because it's relatively interesting and also quite simple once you get it. Right, so now we are going to Unit 3, right? We are moving quite fast, aren't we? Unit 3, Introduction to Financial Statements. So today we're going to focus on, we're going to speak about three different financial statements, right? We're going to speak about the statement of comprehensive income, statement of financial position, statement of changes in equity, right? However, I want us to focus more on the statements of comprehensive income. That's the one we're going to do an example for, right? We're going to do an example for that one. And then our next lecture, we'll do financial position. And then we'll do changes in equity. All right. So now we're going to speak about these different financial statements, right? Because we said, remember when we defined accounting, we say that the recording of our financial transactions, right, for use by specific individuals, right? And we said in financial accounting, this is for the general, right? Unlike managerial accounting, which is for uh internally the business or the managers, right? So in this instance, we are going to talk about these financial statements now, right? And how they'll be recorded so that they can be used by the general public, right? So now let's do this. Okay. So I've already explained we have the statement of comprehensive income, statement of financial position, statement of changes in equity. Now, I'm just going to briefly go through the three statements and then just go deeper into the statement of comprehensive income, seeing as to how our time allows. But I do intend on being done because I think we have yeah, we still have a little bit of time. So now, the purpose of this statement, the statement of comprehensive income, it's also known as the income statement. So don't get confused. If you see income statement, if you see statement of comprehensive income, it's the same thing, right? And also another thing, financial position is also known as the balance sheet, right? The purpose of the statement of comprehensive income is to calculate the profit or loss for an organization during a particular period, right? So we are calculating profit or loss, right? So this statement is generally prepared, remember, in a particular period. That is also very important, right? Not ad hoc, but in a particular period. It could be monthly, it could be a year, right? So this statement is just generally prepared more than once per year, right? Like I said, it could be monthly, right? But generally, yeah, it is monthly. Not very seldomly over a year, but yeah, monthly, right? Or maybe quarterly, right? So profit can be described as the difference between all income and expenses for a particular period, right? Simple as that. I think we've just calculated that, right? Um, Income minus expenses in a nutshell, that's profit, right? So it is an important statement for management since it can tell management a lot about how efficient the business is operated. However, organizations should not only focus on whether the business is making profit, but also how it is generated, right? How we're generating this profit. So now we are coming to the statement of financial position, right? So the purpose of the statement of financial position is to calculate the value of assets, equity, and liabilities for an organization. So remember, there was a reason why Sir James had to do that whole introductory lecture where he was explaining assets, non-current asset, current assets, where he was explaining liabilities, equity, and all that stuff. There's a reason why he did that. For specifically this statement, you're gonna need to know what is an asset, what is equity, what is a liability, because that then will determine where your answer goes, right? That will determine because most of the times you see exactly why it's important shortly. Let me not bombard you with information. Now, the statement of financial position is a snapshot of the accounting equation where assets is equal to equity plus liabilities. So which means that at the end of that's why it's also called the balance sheet because it must balance, which means that our assets should be equal to the sum of our equity and liabilities. Right. So it is an important statement for management since it can advise management on how the business activities are financed with the use of financial ratios, which we're going to do in Unit 6. So we have what we call the acid test ratio, and a few other ratios that we're going to talk about. That is basically the more much less complicated side of it. And we're going to talk about it. It will all make sense, but it's a build up. We can't get to that unless we have done our due diligence here. Now, the statement of changes in equity. The purpose of the statement of changes in equity is to review changes the owner or owners, right, interest has in the business. So basically, to review how much was withdrawn by the owners, how much was invested initially into the business, such kind of information, right? The statement is generally prepared more than once per year together with other statements. Owner's equity can change over time as business assets are acquired using both owner's equity and debt financing, right? So owner's equity can also be reduced if an owner decides to withdraw from the business. So whenever an owner withdraws from the business for personal use, that is what we would call it would be recorded in the statement of changes to equity, right? So it is therefore an important statement for management and other stakeholders to review owner's interest and why it changed during a particular period. Maybe the business is now starting to fail. Right. So now let's look at this. Statement of comprehensive income. So now we're just gonna focus on it on a magnifying glass, right? On a microscopic level. Now, comprehensive income. Okay, so we are also going to learn how to prepare using the example of a sole trader. So the example that we are using, it's a sole trader type of business. Because remember, we spoke about the different types of business combinations, right? We spoke about the company, we spoke about the sole trader, we spoke about the partnership, right? We spoke about the close corporation, right? So these different companies are going to be treated differently in how the financial statements are recorded. But for now, for the purpose of now, let's focus on the sole trader, right? So we're mostly going to focus on companies. Are we going to focus on companies in this module? I don't think so. All right. So in the first section, the gross profit, we have what we call the gross profit. The gross profit is calculated, right, as the difference between revenue generated from sales and the cost that can be directly attributed to the revenue from sales. Cost of sales, remember? So basically that is maybe the amount which you use to buy inventory, etc., etc. So the second section outlines income received from other sources, such as rental or interest income. So basically what I'm saying is that there's what we call other operating income. What is other operating income? It's basically income which you acquire from activities outside the normal operation of your business. So say for example, you own the business you're working in, right? And then somebody comes and they want maybe to rent a corner or one of the rooms in the building, right? The rent income that you get from somebody sharing that business with that building with you or sharing your building is what we would normally put under other operating income, right? And also things like subsidies, commissions, etc., etc., of which most of them you don't have to worry about them now. Right. So we have what we call also operating expenses. So operating expenses such as electricity and repairs are listed, right? We will list these, right? Operating expenses are deducted from gross profit and other income to provide a total for profit before interest, right? Which we also call this EBIT, right? It also refers to earnings before interest and taxation, right? So these are earnings before interest and taxation. That is EBIT, right? So so we have our EBIT value, right? And then we are going to have our final value where all the deductions have been made, right? So in the next section, the interest payments are deducted from the previous total provide to provide a net profit before taxation, right? And then after that we have final taxation calculated for the year is deducted from the previous total to generate a total for net profit after taxation. So this is basically telling us now how we come to the calculation of our net profit at the end. So if ever you're confused about that, this is the part where you should come to. You need to come to this part, right? If you're ever confused about things such as net profit, how are we going on about calculating? But I will try to explain. Right. So this would be a typical format for the statement of comprehensive income, right? We're going to have sales, less. So when we're saying less, we mean minus. And usually when we are minusing, we'll put that value in brackets. That's just another thing which you need to know when it comes to financial statements, right? When it's subtracting, we put that number in brackets. Right. So now gross profit. And then we also have other operating income. Then we have rent received. That's basically an example of other operating income. So under less operating expenses, we're gonna have wages and salaries. So anything that you consider as an expense to the business goes under the operating expense. So basically, the gross operating income, it will now be sales minus cost of sales, right? That will give you the gross profit. Gross profit plus other operating income, it will now give you the gross operating income, right? And then the operating expenses now, we basically sum every expense, any expense that you can think of: depreciation, electricity, rent, wages and salaries, fuel, phone bill, and anything that pertains to the expenses of the business. Right. And then we have profit before interest, which is EBIT, which we'll call normally to be interest received after that. Right. So the value that we get from subtracting operating expenses from our operating income, from our gross operating income, would be the EBITDA value, which I was telling you about, right? And then from the EBIT value, we'll subtract the interest received, right? Which will then give us, and also we can add the interest paid. No, we add the interest received and then subtract interest paid, right? And then after that, we subtract the taxation as well. Then that will give us net profit, right? Sounds complicated, but it's easier than it seems, guys. And I'm here to take us through it. Now, so fashionable clothing. Remember, guys, if at any point you have a question, you don't have to wait for me to um explain. You don't have to wait for me, to ask you. You can just unmute your mic and then ask. You don't have to wait for me to stop. Now, fashionable clothing is solely owned by Susan, whom also manages the business. The following transactions occurred during the month of March 2019, which was the first month of trading. So this date is very important, guys. It's very important. It's very important. You must not forget that because time is very important in accounting. Right. So now we see the first statement. The first statement says, so we must record basically the transactions of this business into the statement of comprehensive income. So we must record whatever must go into the statement of comprehensive income. Right. So we'll be given sentences like this. Even in your exam, you'll be given statements and then you need to record them in a statement of comprehensive income. Now, we see here it says, Susan deposited 50,000 into the business account. Susan deposited 50,000 into the business account. This is owner's equity, right? Where do we record that? Do we record that in the statement of comprehensive income? No, we do not do that. So it's irrelevant to the statement of comprehensive income, right? It has to be recorded into the statement of owner's equity. Statement of changes in owner's equity, right? So now, a business cell phone was purchased cash for 1,200 with an estimated useful life of 2 years. So basically, we're going to have to calculate the monthly depreciation, right? Because we remember this is on a month basis, Right. So what I'm saying now is this. We are not recording the purchase of this cell phone as much as it is an expense, because what is a business cell phone? A business cell phone is an asset. But what are we going to record? The depreciation, because the depreciation is the one which becomes the expense. Right. So now, and then we are then told cell phones are depreciated on a straight line basis. So this is the first thing we are recording in our statement of comprehensive income. Right. So we'll go under depreciation, right? So depreciation falls under operating expenses, right? And then we go under them, and then we are going to uh depreciate, as you can see here. I've already added, but let me just show you how we calculate. Remember our formula for depreciation? We'll say 1,200, right? Divided by 2. That will give us the depreciation for the whole year, right? However, what we need is the depreciation for the month. That is why we are dividing it. Wait, where is this? What is the value of the cell phone? The value of the cell phone is 1,200. Right. So 1,200 divided by 24. Because remember, it's per month. So 2 years is 24 months, right? 2 years is 24 months. So to calculate the depreciation for the month, you can simply divide by 24 instead of dividing by 2. Right. So you get your value there. But basically, I've put the total here. And then I showed the calculation here. So I think for today, guys, uh let us let us let us conclude here, so that for those that were discouraged and lost, or maybe those that are to come that are going to have questions, um we can be able to answer their questions. Right. Let us live here, so that for the sake of our concentration span, I can see that this is now something a little bit new. So um, some of us might lose concentration and we never get the chance to catch this again. So I'm going to conclude here. We've covered quite a lot. And tomorrow, when we meet again, we are going to be doing the statement of comprehensive income in detail when I'm not in a hurry, because time is almost up. So I'm just going to make sure that we do it more in detail. But please do go and revise, review, and find out what are your liabilities, what are your assets, so that you do not get too left behind when we are now explaining these things. Any questions, guys? I'm going to leave the remaining 3 minutes for questions. Any questions, guys? Are we together? All right, Mbafula is all good. All right, that's great. That's great. Um, Barbara, are we all right? Are we all right? I'm okay, need to read. Yes, some of these things is just a little bit of maybe background knowledge that you need to revise, but I'm gonna try to take it as slow. That's why I decided to stop here, so that I can slow down and really explain to you guys, so that you also don't feel rushed. Maybe some of you are really tired, because once 1 hour is done with our concentration spans these days, um, people will no longer be paying attention. That's why I decided to stop here. But otherwise, please do come with your questions. Maybe now you don't have a question, but as you're going on reading and all, you get a question. Please do come with them. Nonetheless, that's it from me today. I will send the notes through, so you will have the notes before we even I don't know if that's a good idea. Okay, rather I'll send the notes once. I'm done. Right. So, have a lovely rest of your night, guys. Until we meet again.